The next component to consider here is the accessibility of your funds. This is going to have an impact on your monthly cash flow as well as the age that you begin retirement. The IRS has requirements in place for retirement accounts, and early withdrawals are not recommended. This will in most cases result in taxes being owed in addition to a 10% penalty. For individual retirement accounts as well as annuities and 401ks, the minimum age to begin distributions without a penalty is age 59 and a half. In addition, with the Roth IRA, you need to make sure your first distribution is greater than 5 years after opening your first Roth IRA account. So if you're planning on retiring early, say in your 50s for example, it's extremely important to take this into consideration. That's because you're going to need to have a source of retirement income outside of these accounts to cover your retirement expenses up until 59 and a half. Social Security benefits, on the other hand, have a different set of rules. The amount that you receive in Social Security benefits changes based on whether you start taking it between age 62 to age 70. You can start claiming your Social Security benefits as early as age 62, but this will result in benefits being reduced by 25 to 30%. Depending on what year you were born, waiting until age 66 or 67 will enable you to receive full benefits. On the other hand, if you decide to delay receiving your Social Security benefits, they will actually increase for a set period of time. This is going to be a set percentage for each month you delay taking the benefit beyond the full retirement age of either 66 or 67. And the table at the bottom right shows us the monthly and annual increase in benefits associated with delaying claiming Social Security benefits. And the rate of increase changes based on your birth year. However, the increase in Social Security benefits stops at age 70. If you decide to wait to claim Social Security benefits beyond the age of 70, there is no additional benefit. And since you're able to claim Social Security while still working, it's generally not recommended to hold off on claiming benefits beyond the age of 70. Now, another important consideration which could impact the availability of funds is RMDs. The IRS requires you to start taking these required minimum distributions from your IRAs or 401ks once you reach the age of 73. And these RMDs are calculated separately for each of your retirement accounts, so it can get complicated quickly. The IRS has a uniform life expectancy table, and this is used to calculate the required minimum distribution on your accounts. It's often helpful to consult with a financial advisor or a financial planner on this topic. Now, it's extremely important to both understand these RMDs and to begin taking them by the age of 73, as the penalty for not taking them can be as high as 50% on late withdrawals. However, in recent years, the IRS has adjusted this to a 25% penalty, which can be lowered to 10% if corrected within 2 years. Either way, you don't want to end up paying these penalties, so plan ahead for your RMDs. As an action step here, you should take some time to get a list of your different retirement accounts and income streams. Then you should figure out whether or not these will be available to you when you actually plan on retiring. If they aren't, you might need to look into some alternative income streams outside of retirement accounts or adjust your target retirement year. In addition, you should also put together a plan for when you'll start collecting Social Security benefits.